Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to the latter part of the week. We've almost reached the weekend, which is good news, I think. This is Peter Lewis with Money Talk on Thursday, the 23rd of July. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 90 million customers across 10 countries. In today's business and finance headlines, Donald Trump has threatened a new escalation of the Iran war, warning the US will soon launch an attack on a heavily fortified nuclear site. The US struck Iran for the 11th straight night on Wednesday. Trump said he thought Iran may have moved components critical to building a nuclear weapon to a deeply buried facility beneath Pickaxe Mountain in central Iran, and will be hitting that area pretty soon and very heavily, he said. Brent crude oil was 3.4% higher at $94.07 a barrel on Wednesday, the highest level in 6 weeks, after US Secretary of State Marco Rubio said Washington remained committed to diplomacy, but accused Tehran of violating the two sides' agreement over the Strait of Hormuz. The problem we're having right now is they're not serious about talks, he said. Donald Trump is preparing to impose a new round of tariffs by Friday as his temporary 10% global duties expire. The administration has proposed at least 10% tariffs on goods from 60 economies, citing lax forced labour standards, with higher 12.5% duties planned for major exporters such as China, India, Japan and South Korea. The move follows recent escalations, including 50% tariffs on Canadian goods and 25% duties on Brazilian products. Indonesia's central bank unexpectedly left its benchmark interest rate unchanged, shifting its strategy from an aggressive monetary tightening campaign to offering a raft of new incentives to support the rupiah. Bank Indonesia left the BI rate at 5.75% on Wednesday, standing pat after raising rates by 100 basis points in May and June. A slim majority of economists had expected another quarter-point increase to shore up the currency. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Louisa, China equity strategist at the Bank of Singapore. And with a view from Taiwan is Ross Feingold, Director of Research at Caerus Consulting in Taiwan. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street Wednesday, investors turned cautious before Alphabet's earnings report and as oil prices and bond yields climbed. The S&P 500 index dropped 0.1% to end at 7,499. The Nasdaq Composite slipped 0.6% to 25,691. The Dow lost 6 points and closed at 52,219. After the bell, investors passed earnings from Google parent Alphabet, automaker Tesla and IBM. Alphabet posted 24% revenue growth in the second quarter, fueled by its booming cloud business. But the company's free cash flow turned negative for the first time in decades as it continues to spend heavily on data centers for AI computing. Google lifted its full-year spending guide, expecting capital expenditures to range between $195 billion and $205 billion US. Shares of Alphabet were down 4.5% after hours. And Tesla's quarterly profits fell well short of estimates, and the company reported free cash flow fell for the first time in more than 2 years, thanks to $5.8 billion in capital expenditures to expand its footprint in artificial intelligence and robotics. Net income fell 5% to $1.11 billion US. Tesla shares were down 3% after hours. In the bond markets, the 2-year Treasury note yield rose 4 basis points to 4.3%. The yield on the 10-year US Treasury note was up 3 basis points at 4.66% and approaching its 2026 peak. The US dollar index held above 101 on Wednesday, supported by higher Treasury yields and rising oil prices. The yen was unchanged near a 40-year low of 163.15 yen per dollar. The offshore Chinese yuan weakened 0.1% to around 6.77.5 renminbi per dollar. Gold prices surged to a 2-week high. Spot gold was trading at $4,130 an ounce. That's a 1.3% rise. Bitcoin was down 0.8% over the past 24 hours at $65,900. Asian stocks climbed Wednesday, helped by a rebound in chip makers that offset Middle East worries. South Korea's Kospi index ended the session 0.7% higher. It was up 6.2% at the high of the day. Japan's Nikkei 225 fell 0.2% to close at 66,116, pairing gains of over 2%. And Chinese stocks were lower. On Wednesday, Hong Kong's Hang Seng Index fell 240 points or 1% to 24,893. Mainland China's CSI 300 fell 0.5% to close at 4,717. Futures markets pointing to flat opens for the Hang Seng in Hong Kong and the Nikkei 225 in Japan this morning.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's time to welcome our guest. We have with us our regular Thursday morning commentator, Andrew Freris, who is the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning, Peter. Good morning.
And also joining us from Hong Kong is Louisa Fock, who is China Equity Strategist at the Bank of Singapore. Welcome back, Louisa.
Thank you, Peter.
Now, Chinese stocks were lower on Wednesday, as you heard there in the headlines, but earlier this week, state-backed funds stepped in to stabilise the markets. 5 major state-backed insurers, including Ping An Insurance Group and the People's Insurance Group of China, publicly touted the long-term investment values of Chinese stocks, and they committed to continuously expand their equity holdings. The 5 institutions manage almost $3 trillion in total assets. The two of the state-backed investment holding companies also said they had bought almost $9 billion worth of Chinese stocks to prop up the market. And in addition, more than 40 listed companies disclosed plans for stock repurchases or stake increases on Monday, with combined values estimated at around 10 billion yuan. Andrew, I'm a bit bemused by this. Why do the authorities feel the need at the moment to step in and support the markets? Obviously, we have had some of the tech gauges in China fall into bear markets, down more than 20% from their June highs. But nevertheless, it hasn't been a particularly disorderly decline, has it? And the corrections, bear markets are quite normal. So why are the Chinese doing this?
Very, very unusual, because in general, most major government, major economies in major markets avoid actually supporting the stock market unless there is an absolute crisis. The United States has done that, but that was 08, or was it 87? But for reasons very specific to stabilizing. But here, simply buying it in order to soar up the price, I think it's a waste of money, quite frankly. And also, they could be spending that money is something else, which at least could potentially increase consumer spending. The concentration of increases in prices in the budget of consumers and reflecting back to their spending must be a very, very tiny percentage of the 1.2 billion people in China. Yeah. Anyway, it's their money and their choice, but I don't understand it either. And if asked, I will say I don't like at all the idea of the state stepping in, other than in a crisis period, okay, to simply prop it up because prices have been falling. Well, too bad.
Yeah.
Why they don't do the same thing with the property sector? Buy empty flats kind of thing. I mean, it's not an unreasonable question.
Yeah, I mean, it is odd, isn't it? They have done this before. They did it last year when we had Donald Trump's tariffs. In fact, it was even bigger, I think, last year than what we're seeing at the moment. Well, Louisa, what's your take on this? One of the targets of this state support appears to be the Star 50 index. The Star 50 plunged by a record 17% last week. Then the largest ETF tracking the index attracted about $2 billion worth of inflows on Monday alone. And that helped it to rally 11%. I mean, if anything, this sort of state intervention is just making the volatility worse, isn't it?
Hi, Peter. Well, put it this way, the so-called national team has had a long track record of participating in the market. I mean, if you look at year to date, if we just simply looking at the Asia ETFs as a proxy for the national team actions, at the beginning of the year, namely in January, we've seen major outflows, and the participation of national teams definitely has coming down. And I think month to date in July, the if we look at all Asia equity ETFs, the net inflow has already exceeded more than 350 billion RMB, which is one of the major inflow or so-called buying signal by the national teams. Again, the national teams has a relatively long history in participating in the equity market as so-called a role of being a stabilizer. And I think if you put this together with all the other signals that we are seeing, for instance, the support to the tag, like what you have just mentioned, traditionally is the CSI 300 index that have been the major recipient of this national team participation. But like what you have mentioned just now, some of the tech-focused board, like the Star Board or Chinex, also being part of the beneficiaries or recipients
but why
of
does
this national team inflow.
Louisa, why does the market need stabilising? I know some sectors, particularly the tech sector, have fallen into a bear market, but that's happened all over the world, hasn't it? It's happened in South Korea, it's happened in Taiwan, in Japan, and bear markets are just a normal part of equity investing. You have to expect them. Maybe these days they've become rather rare, and maybe there's some traders around who have never seen a bear market before. But in general, most of us with longer memories have experienced several bear markets. So why does the market need stabilising? Why is the authorities and the CSRC trying to send out this message that it's trying to do that?
Okay, I think one of the signal is because, like what I've mentioned, at the beginning of the year, national team participation has come down significantly. One of the proxy to look at is the Asia equity ETFs. Instead of seeing inflow, it has massive outflows with daily net outflows at one point more than 100 billion RMB, which was quite sizable. So I think one of the thing is to look at when will the national team will stepping in again, participate in the market. And we are seeing this time, this is one of them. Secondly, I think as you notice that in the equity market, in the second half, we will be seeing quite a bit of the so-called AI stroke new tech advanced manufacturing IPOs are coming to the market. I think later this month, we will have one of the largest IPO over the past 4 years, focusing on the memory sub industry in the tech space.
Okay. I mean, Andrew, I'm wondering if perhaps the authorities are a bit worried about what's going on elsewhere in the region, particularly Korea, where, at one stage the Kospi was up about 115% year to date, and it's given up quite a big chunk of that now. But we have seen a lot of leverage, haven't we, from retail investors in Korea in a way that perhaps we haven't seen in China. But are they sort of looking over their shoulders and maybe worried about what's happening elsewhere in the region spreading to the mainland?
Well, perhaps they're even looking further, Peter, because if one looks at either, let's say, Bloomberg's index of the 7 big ones, and then you look at the Philadelphia index of the prices of chips, you are seeing really the hand writing the message on the wall. Things are not well, and they are getting potentially worse. And even the site of Alphabet saying we're not going to spend less on AI investment, we're actually going to spend more. and also explaining that the majority of that goes into cloud computing, which is bought by companies that need the space and the cloud facilities in order to develop their artificial intelligence. We're now having, I am spending more because they're spending more on artificial intelligence. And my reaction is, and I would like to know the companies that are buying from Google, what are they planning to spend it on and who is going to pay for that? Sorry, this is very, very long-winded. And the answer is we are sitting on a market which by now it is so familiarly overbought in a sense, and the artificial expenditure and the expenditure on artificial intelligence is so large, and without any really specific detailed plans how this is going to be paid back, which perhaps the Chinese are saying all this is going to come down and come down very quickly, and we've seen some signs of that. I'm particularly concerned about the Philly index of chips. I mean, this is very, very fundamental, very basic, and it's coming down very sharply. And then possibly they're doing just that, as you say, looking over their shoulder. Sorry, this was a little bit long-winded, but effectively, yes, they're seeing what is happening elsewhere, and they would like to prevent this from happening in China. They will not be able to, of course. Okay, that's going to be lost money. Once the markets go down, they go down very, very sharply. Yeah. And then you're actually wasting your money trying to support a falling market.
It'll be interesting to see how the market reacts to Alphabet's results tomorrow, particularly its free cash flow turning negative for the first time ever since Alphabet was listed several decades ago. I want to explore in a moment a bit more on the artificial intelligence theme. But before we do that, Louisa, let me ask you, knowing that there is this support now behind the market from the national team, does this now change your outlook for Chinese equities?
I would say no, the short answer, because, for instance, our preference on the onshore Asian market over the offshore has not changed. I mean, the rationale and the reason behind it, first of all, the industry structure, it has broader exposure to the broader AI thematics. I mean, if you look at from a market cap perspective, close to 2/3 of the market cap are in this industrial, IT, and related services. Also, secondly, from an earnings growth perspective, we've been seeing upward earnings revisions in the onshore market, with 2026 earnings growth is forecast to be more than 20% based on consensus estimates. And lastly, is the lowest correlated markets with the U.S. Or U.S. equities market. So in times of rising volatility in the external world, this would be the lowest correlated and could be a good positions within a whole portfolio.
And some people are saying, look, given what Andrew is saying, that, there are whole swathes of the markets that are overvalued all around the world. Some people are saying Hong Kong, by contrast, is actually cheap. I mean, Michael Burry, of the Big Short fame, is one of those who is saying that, this is a good time now to be looking at Hong Kong stocks. Do you agree with that? Are they looking cheap compared to maybe the rest of the world and the tech sector elsewhere in the world as well?
Yes, I mean, if you look at Hong Kong market at the index level, obviously PE is it's not demanding, but I would say it's not at a distressed level. But if you look at single securities or single industry, for instance, some of the leading players in the internet and platform industry, they are trading at probably 5-year low valuations. Yes, to a certain extent, the earnings growth is not as robust as some of the companies or markets in North Korea, for instance, in Korea or Taiwan. But I think certain companies has become a so-called value has definitely start emerging, even assuming a low single-digit earnings growth environment or even no earnings growth environment. Yeah.
Okay. Well, look, Andrew, I want to get back to this AI theme. We were talking about Alphabet a bit earlier. In its results, it's basically saying its capital expenditure is going to increase once again. It's going to be between $195 billion and $205 billion for this full year. I mean, they are astonishing numbers, aren't they? And that's up from what it projected before. Back in April, it was projecting 190 billion. Now, this links into what's going on in China because we have Moonshot, which has come up with its own AI model, Kimi K3, I think it's called, which is almost as efficient as some of these US models, but costs about 40% of the price. So I'm wondering how much of a threat this is to this type of expenditure, because to spend that type of money, $200 billion, you're relying on corporations paying premium prices for your services, except those same corporations have got now some cheaper, much cheaper alternatives coming out of China. So sort of bringing this two together, I'm wondering, first of all, what this means for the Chinese AI models and what it means for companies like Alphabet, Anthropic, OpenAI and the likes.
There are two parts on the answer. One, of course, is the extent to which this becomes pure politics, and the powers to be will decide that they will not want to have software that has been developed in China, and by necessity, given, of course, that these are large language models which require an enormous amount of information that Chinese sources alone will not be able to supply it, because stepping on dangerous territory here is, of course, our models, in inverted commas, out in the West depends on a huge access to the internet. Well, in China, the access to the internet globally is limited. So I'm always wanting to know where does the information comes from in order to make this model work so efficiently as they are, in order also to make them cheap. And one senses that one of the arguments that particularly United States will use is we're not going to let them dip into our internet sources, again, in order to make their models work better. I know this is politically loaded, what I'm actually saying, but that is the reality. These models require access to a colossal amount of information.
But also, it's working in the other way as well, isn't it? Because we've got Chinese regulators who are now saying they don't want foreign firms accessing their models either. So it's sort of, how is this all going to end up? Are we going to have, models that will become sort of unique to certain geographical areas at this rate? But this also is surely this is a threat to what China is saying, which is it wants open source models where everyone has access to them, except at the same time, it wants to try and protect somehow what it sees as its proprietary interests.
Yeah, as I said, this boils down to understanding, in fact, the way that artificial intelligence models operate, and they don't operate at all on the way in which we used to understand. There are effectively huge dictionaries, basically, and these dictionaries require astronomical big and free access to everything which is going. If they are going to be able to answer, you can literally call them up and say, what is the best flight I can take to go to Puerto Rico for my holidays, all the way to saying the minimum dose of glucose on a diabetic patient. I mean, they have to have access on all this instantly. And I still don't understand how this could potentially work within the Chinese environment. And why will the Chinese being unwilling to let other people dip into that? I'm sorry, again, I don't understand that, because I don't understand the extent to which free access to internet, is an essential part, or it is not. And if it is not, then I'll stand corrected, and what I'm talking is nonsense. And that's not the first time, Peter, incidentally.
No, you're making a lot of sense. I mean, Louisa, let me get your thoughts on Moonshot and this Kimi K3 model. Is this another DeepSeek moment for the markets?
I would say it's definitely getting global attention. Especially when China is facing compute constraints. If you look at some other third-party performance assessment, for instance, if you look at like artificial analysis index, Kimi K3 just ranked at the moment number 3 on a global basis after Claude 505 and GPT 5.6 Max. That's significantly narrowed the performance gap of these China frontier model versus the global leaders, especially those in the US. And I think from a across supply chain perspective, it's definitely have both positive and negative read across. Definitely with Kimi K3 rollout, it will positive for AI infrastructure, for instance, compute demand, cloud demand, further push for China semi-localization, memory, networking, etc. But it's also highlight very keen competition among the frontier models, not just locally in China, but also on a global basis. The other thing is, from a cost basis, within China domestic market, the pricing is actually on the up, whereas if you compare on a global basis, it's still pricing at a discount. So it's definitely will have raised a lot more questions regarding not just competition, but also on the monetization, pricing model, etc.
I mean, this is a real race, isn't it, between the US and China for global supremacy in AI. Most people had assumed that the US so far was leading that race. It had a significant advantage. But this moonshot announcement, does that change that sort of perspective that maybe China is not as far behind as people thought? And also, I mean, you know, some of the things that these models can do are way, way beyond what most people use AI for, whether it be companies or individuals. And therefore, you don't need to pay big prices to get, you know, the cutting, the state-of-the-art model. Something that, you know, Moonshot comes up with will more than do the trick, particularly if it's 40% cheaper.
I think the other impact, exactly like what you've highlighted just now, is with pricing become more supportive, the deployment and proliferation of these model, the user case or users will definitely got a positive push on the back of this.
Yeah. I mean, Andrew, we're going to see obviously the market reaction later today to these Alphabet announcements, but it sort of does beg the question, doesn't it? How can you carry on spending your capex at that sort of rates, your cash flow turning negative? I mean, these companies, which used to be asset-light companies, didn't have any borrowings, are now loading up on debts to basically invest in something where the returns are very uncertain.
Yeah. Well, Peter, you know, I'm not going to earn the Nobel Prize of not economics, but of insightfulness in the market. We have known this for several months now, and we have, at least to my satisfaction, I have not been getting even an approximation of an answer. Okay, you're spending all this. Now, name me the type of programs or the type of facilities you are going to create, and the type of clients that will be buying it, and how much you plan to be charging them. Zilch on that. Absolutely zilch. And that, of course, you know, my advice to my clients is stay clear of anything that has AI and is related to United States. By extension, stay out of the major US indexes, because these are going to be driven down, and concentrate instead on very specific sectoral issues that are not necessarily related to artificial intelligence, and also where we know where the money is spending. And yes, Peter, what this is going to be, it's going to be, of course, defense.
I knew it.
And it's going to be, of course, investment in green aspects of economy, because one of the best things that has happened to conservation is the Strait of Hormuz. I'm so pleased this is happening, and also I'm absolutely thrilled that the Iranians are going to really shoot themselves on the foot, because within a year and a half, Hormuz will be irrelevant. it would have been substituted by a lot of different things. So the Iranians will not have anything to choke on, other than choke themselves, I imagine, okay, on this. It's one shoot, one bullet weapon is always absolutely non-lethal because, of course, it can be substituted instantly.
But in the short term, it is having an effect, isn't it?
Oh, absolutely, absolutely. That's why I said year and a half we're going to suffer. After that, we will be lying back and saying, what was this all about? And the Iranians will be looking at an empty strait, and they are very welcome to choke it all they want. It's an exaggerated statement, but it would have been substituted. Peter, the economies are capable of substituting in the markets at unbelievable rates. I'm making a huge collection of substitutability in the most unexpected way, and I'm stunned that I might be the first one that is looking at that because it's not something that sells, and also it takes quite a while. I'm not going to make money by simply pointing out that the Straits of Hormuz will be substituted. Good. So what do we do in between? The answer is suffer. Okay, there's nothing, not much as intelligence, or give in, okay, which neither the Americans nor the Iranians are planning to.
Okay, well, Louisa, let's wrap up with your thoughts on the outlook for China, both for the markets and maybe the economy, if you like, as well, because China's cabinet has said it's going to meet its full-year growth target, even though second quarter GDP slipped down to 4.3%. So what can we expect there, Louisa? Are we looking at some more stimulus, maybe some freeing up some local budgets to go and spend more money? What are they thinking of?
I think, as you know, heading into the end of July, there will be the July Politburo meeting, which is another one that's focusing on economic issues. I mean, with the soft economic activities in 4Q, we do believe that there will be some policy step up, and also fine tuning, but we do not expect like broad-based major pivot like what we've seen in the past. I think the focus is still on the deployment and execution for whatever has been announced at the beginning of the year. One of the example is from a infrastructure perspective, the so-called 6 networks that has long been mentioned, and we did get more detail back in April. That will probably potentially one of the focus. I mean, for the 6 networks, like probably we're looking at like RMB 7 trillion over the next couple of years. So that would be one of the example. Yeah.
And what's your target for the Hang Seng and for the CSI 300 for the rest of the year? And what's your outlook?
For Hang Seng Index, we are our target is 26,000. We do not have a target for CSI 300. Yeah.
Okay. And any particular themes that you're looking at that are going to take the market there over the next sort of few months?
I think we've been highlighting a barbell strategy will be appropriate, especially for quality yielders. They have definitely demonstrate the resilience within the portfolio, which is also offering steady income. Like, for instance, some of the Chinese banks, some of the high dividend yield play, the performance over the past month or during the time when we have the Middle East tension on the rise, they demonstrate the low volatility, low beta, and also with the dividend income, the positive elements in that. On the other hand, we're looking for upside optionality from some of the high growth industry, namely policy beneficiaries, and specifically if we drill down into the industry, that will be the AI beneficiaries, and not just like the IT hardware or some of the particular internet and platform company with a visible AI catalyst. But we do believe that positive impact will spill over and across the whole supply chain, spanning across even up to the upstream. For instance, such as within the material sector, copper is one of the potential beneficiaries on the back of favorable supply and demand, and also increasing demand from all these AI build out and green transition as well.
Okay, well, thank you both very much. You heard there Louisa Fogg, who is China Equity Strategist at the Bank of Singapore, and our regular Thursday morning commentator, Andrew Freris, who is the CEO of Ecognosis Advisory. It's time for our regular updates from Taiwan, and I'm joined as always by Ross Feingold, who is Director of Research at Caerus Consulting in Taipei. Morning, Ross.
Good morning.
Now, it seems that tariffs are back on the agenda once again, doesn't it? The US is going to impose 50% tariffs on Canada, and also it looks like the Trump administration is considering tariffs on about 60 other countries, which have come recently under this investigation into forced labor standards. The Trump administration says these countries have lax standards, so economies like China, South Korea, Japan are facing 12.5% tariffs. We thought maybe this had all gone quiet, but clearly Trump sees this as a major part of his agenda going forward for the second half of his presidency.
Absolutely. And we knew in the period after the arguments in the Supreme Court and before the Supreme Court issued its judgment in the tariffs case that the administration was preparing additional legal basis to issue tariffs or impose tariffs on countries. And the fact is, and they were correct, there are a variety of different sections of U.S. laws that could be cited as a basis for imposing additional tariffs. And the administration knew, should they decide to do that, the process would have to play itself out again, in the sense that if somebody thinks that it's a flimsy legal basis, then they're going to have to litigate. The domestic importers in the U.S. and the other countries would have to choose between accepting it or retaliating or negotiating. So it doesn't come as a surprise that the Trump administration is doing this. Now, the tricky thing here, besides legal arguments about the basis of it or is it good public policy, is simply the cost of living issues. And what is this going to do in that regard, especially as we approach the midterm election?
What is it that Canada has done wrong to attract 50% tariffs?
I guess by existing, Peter. It seems to really be one of those countries that, for a variety of reasons, truly annoys President Trump. Now, this happened in the first term. Obviously, Trump did not get along well with Trudeau. There seemed to be a window last year in the spring of 2025 when Carney came into office that there was some hope for a positive relationship. But it's a combination of things. Some of the restrictions on dairy imports continues to really annoy President Trump. Obviously, there's the whole 51st state debate. Ironically, Carney's opening to Chinese EVs and other efforts to improve Canada's trade relationship with China over the past few months has annoyed President Trump, even though he's pursuing something similar with China as well. Maybe he's just a little jealous that Carney has achieved some more openings on trade with China that Trump is still seeking as far as big announcements. And now we have the issue with the fires in Canada, the wildfires that has caused smog to travel over to the United States, as smog tends to do. And it's just overall a very bad relationship.
I mean, trade between the US, Canada, Mexico is governed by the USMCA framework, which is sort of coming up for negotiation. Is Trump fully prepared to blow this up if necessary, if he doesn't get what he wants?
I think so. I don't, at least at the moment, it's clearly not a legacy issue for Trump to create another version of the agreement. He certainly doesn't want to extend it in its current form. That's clear. So then the option becomes, okay, do you renegotiate and create another new grand deal? At least at the moment, it doesn't seem like that's what he wants one of his priorities to be. In fact, at the moment, it seems that the priority is the opposite, which is to have a legacy where he could say, I really ended preferences, in his mind, preferences that Canada was receiving for too long.
And is he prepared to blow up his trade agreement with China? He's talking about now 12.5% tariff on China, because, along with many other economies, for what he says are lax forced labour sort of standards. It's hard to imagine China accepting that, isn't it, and not retaliating. And presumably it's hard to imagine that in that environment, President Xi Jinping would want to go to the US later this year.
There certainly will be retaliation from China on what goods or services they impose. That retaliation remains to be seen. Of course, there'll also be a lot of political rhetoric coming out of China, and they might win some of those arguments, at least in the eyes of policymakers in other countries, because China's going to say, you're not playing by the international rules, and you're the country that's historically been talking about that and criticizing China for not playing by the rules, but you're not playing by the rules of international trade. So I would expect China's media and government officials to make that argument. And again, there are going to be some officials, including here in Asia, where so many of the economies are export dependent. They are going to agree, and ironically, it's going to buy China some goodwill. Now, on the visit by Xi Jinping, as you know, I've been a skeptic about whether or not that will happen, especially since there in theory would be two visits this year, one for the one-on-one meeting with Trump in September. Then the second one would be for Xi Jinping to attend the G20 in Miami in December. And then in the middle, in November, there's the visit of Trump to Shenzhen for APEC. I've been a skeptic that any of those are going to happen, and I just will repeat what I constantly say, which is until either leader is on the airplane, I think we should be cautious about assuming it's actually going to happen.
Now, there's another flashpoint, because Donald Trump has accused China of meddling in the 2020 US election. He claims the Chinese government stole more than 220 million voter files. Now, we should point out that there was a 2021 intelligence report into this, and they found no evidence whatsoever that any foreign actor had attempted to alter voter registration, ballot casting, or vote tabulation. And China, of course, has rejected those claims. Why is Trump raising this now?
It's part of the ongoing debate in the United States about this legislation called the Save America Act, which Republicans in Congress overwhelmingly support, with a few exceptions. And the problem for the Republicans is because there are a few Republicans, specifically in the Senate, who don't support it. They don't have enough votes to pass it. And President Trump has made passing this legislation a priority. It would impose significant new ID requirements, along with other new regulatory requirements in the conduct of elections in the United States. And President Trump's been talking about this legislation for months. He's been pressuring Republicans in Congress to figure out how to pass it and make it into law. And as we get closer to the midterm, he's probably going to keep talking about it if it doesn't pass, because one of his major political selling points or marketing points is to question the security of U.S. elections. So raising it now is all part of that conversation. But you cited the intelligence report, and that ultimately is the key thing for a lot of people who look at this issue, which is to say, no votes were changed. Nobody stuffed the ballot box as they might have said in the past, or nobody hacked into these systems and actually electronically changed the votes. Nobody moved votes for Trump from Biden using hacking methods. But the debate about whether or not bad actors are putting fake news or otherwise trying to manipulate voters, that won't go away. And we see that not just in the United States, but we see that in other countries as well. But what's always an interesting area of discussion, and where people have often they have partisan views, frankly, is that they'll say, but we've been manipulated. Our voters are now confused. They're voting for somebody they wouldn't have otherwise voted for because of the disinformation or misinformation. And that discussion won't go away.
Okay. Well, now the other area where there's competition between the US and China is in artificial intelligence. Now, it has been assumed that the US does have a lead over China in these AI models, the development of them by firms like OpenAI, Anthropic. But then earlier this week, we had Moonshot release an AI model known as Kimi K3, which really challenged those assumptions. It considerably narrowed the performance gap with some of these US models, and was a fraction of the cost as well. So how is the US administration reacting to this? Because it doesn't seem to have a consistent response at the moment to Chinese developments in this field.
Well, there will always be one part of the U.S. response which is consistent, which is to say that companies in China stole the IP from American companies. So highly likely we're going to hear people saying that, including government officials or members of Congress. But the one important thing here to keep in mind is never underestimate China's ability in the technology space, whether it's with AI models or chips. Even if we think of China as a few paces behind the United States, we know that China has an extraordinary ability to catch up because they have the financial resources and they have the talent to do so. So catching up is not a surprise at all. But we saw with the recent conference, and I think this is an important thing to watch, the recent AI conference in Shanghai, which Xi Jinping himself attended and made a speech, that the two sides are going to be competing not just for creating the models, but then for their usage around the world, including with different regulatory models or rules of the game that they would encourage users to follow, as far as moral and other issues that the use of AI creates. So that process is going to keep playing out going forward, and it's going to be very similar to something that, in retrospect, looks less complex than AI, and that's what we saw with the United States, mainly during the first Trump administration, putting a lot of pressure on countries around the world to exclude ZTE or Huawei equipment from their 5G or, in the future, 6G mobile network. So I think we're going to see the Trump administration and its successors follow that playbook and encourage countries to, frankly, ban or impose regulations that make it very difficult for corporate world or consumer users to use models or AI from China.
I mean, as you mentioned, the importance China is putting on this is highlighted by the fact that Xi Jinping attended the World AI Conference in Shanghai. He clearly wants China to be at the forefront of regulating AI and rules that govern the international use of that. He's launched this China-led World AI Cooperation Organization, which is going to be based in Shanghai. It's already got 29 countries, mainly in the global south, to sign up to that. I mean, is this a realistic ambition that China is going to be setting the rules globally for AI?
And they'll set the rules for models that come from China, but they're not going to set the rules globally. AI that's created or models that are created in Europe or the United States, they're obviously not going to follow Chinese rules, and they're probably not going to be used in the Chinese market. Where the competition will play itself out is very similar to the example I used with 5G and 6G. We're going to have a country or a city in the global south, for example, has the opportunity to buy some kind of package software that includes AI it could be for public health, it could be for regulating transportation and traffic flows. And there's an option from China and there's an option from the United States. And the United States will say, well, how could you possibly use the AI model from China to improve traffic flow or public health? And there'll be some city in the global south that'll say it's a quality product. They've proven it works. We flew to cities in China and saw them using it. And we're not worried about our data being stolen in this context. And the United States is going to say, well, of course you should be worried about your data being stolen and giving China access to the information of your consumers or whatever the data set is, and you'd be better off using the United States made model. Oh, and if you don't, we're going to impose some punishment on you. That's probably how this will play out.
That's Ross Feingold, who is Director of Research at Caerus Consulting in Taiwan.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. Do please take a look at my newsletter at peterlewismoneytalk.substack.com for more information on today's top business stories from across Asia. I'm here again tomorrow for the final time this week, and I'll be joined by Francis Lun, the CEO of Venture Smart Asia, and Mark Toe, Managing Director of Asset Management at the Wing Fung Financial Group. With a view from Australia, it's Toby Lawson, the former CEO at Staten Partners. See you tomorrow.
Money Talk